So markets went crazy on Friday, and let's discuss if we are actually on a start of a bear market or if it's just a temporary hiccup. And it's all about liquidity and all about counter currents that affect liquidity. So let's discuss them. But first, let's just look at the numbers here and the charts where the S&P 500, the risk on market by excellence, was on a roll for sure for many days, as we know, on an extraordinary run. So the only downturn was about Liberation Day by March, April, and we were on a run, and all of a sudden we fall from not really a cliff so far. It was just one day, but maybe it's another kind of correction. So we have to wait and see. It never goes on a straight line. Also, the dollar tells us an interesting story because we did have on the DXY the whole narrative of the dollar is dead, the American exceptionalism and so on, and DXY was just coming down. So that means DXY is actually the index comparing the dollar to the most important currencies. Like the yen, the euro, the pound, the Swiss franc, and so on. And it was actually coming back. So the swing is starting to come back. So it went back to 100, but now it just got rejected all of a sudden on Friday, back to 98. Also, Bitcoin for sure. Our liquidity barometer, right? It's very interesting to see that despite the correction, so from 119, so 119, right now at 113 as I record this video on Sunday, it's still pretty stable. So it's not a big of a correction as of yet, but we still have to wait and see. So it's still pretty interesting to see. But let's actually discuss about the forces that are influencing it. If you follow our reports at report 20 above the clouds post-rally outlook from a couple of weeks ago, I discussed on the monetary mechanics section what we call the winter is coming, but don't worry. So actually we were expecting a downturn, but for a little bit of different reasons that could still be in play. And this is what we call the short-term theater and drama that can influence markets, and that's for sure what happened. But we can also take into consideration the fact that not only we had very bad jobs numbers, and also after the FOMC meeting with Jerome Powell, which was a disaster in my opinion, because they just had those pre-scheduled meetings where they have absolutely nothing to say until the data comes 48 hours later to show that the data they were actually expecting to decide if they should cut interest rates once and for all actually showed that they basically should. And this creates a whole scenario with poly market just going crazy and expecting now almost with 70% that the Fed should actually be cutting rates in September. And there's a whole drama if it's politicized or not, but we discuss in all of our reports that actually it doesn't really matter because it's not about the Fed. It's all about liquidity, and liquidity is not created by the Fed. It's created by the Treasury, because the Treasury is actually the one that producing fiscal spending is the one driving liquidity in the US by far. Regardless if you cut interest rates, it does not matter at all. It actually, I would argue, it's the contrary. By cutting interest rates, you're actually shrinking the possibility of fiscal stimulus, because high interest rates are actually the ones that are stimulating more spending, so which is very counterintuitive if you understand monetary mechanics. So we discussed that into pretty deeply in our report. So if you want to have access to it, you can click on the link on the description below for this one and our latest one as well. And this is a big story that we talk about a lot, which we call the TGA refill, which is one of the forces that I would expect to create some turbulence, but it hasn't yet. That's the interesting part. So the TGA refill, so basically a refill from the checking account of the Treasury, what comes from taxes, also for tariffs that had just started, which is one of the forces that is creating a lot of turbulence right now. But it's all about T-bills and U.S. debt being reissued, because the debt ceiling has been raised, and now Scott Bessent is able to issue more T-bills. But by doing so, you create kind of a turbulence there, because once you issue T-bills, you drain liquidity from the markets. This can also create some downward movement into the S&P 500. I would not be surprised if we see a further downturn coming up based on that. However, as we also discussed on our latest report, Scott Bessent is kind of trying to smooth out that curve, trying to make it not too quick, not to drain too much liquidity at once, but at the same time provide to the market the T-bills they need, because there is a huge demand for them, because as we always discuss on these videos, it is collateral. Collateral is needed for credit creation. So you see, T-bills being issued, they drain liquidity, but at the same time, if given to the right people, which are banks, they're able to use them as collateral to generate more liquidity. So it's all a balance to understand which force is going to be the highest. So I would take a look at the TJ refill. But right now, our base case, at least as we discussed with subscribers, is the fact that fundamentals have not changed. So the United States is set up for a huge liquidity provision, but we are to expect, as we said, a lot of turbulence. The problem is we never know what the next tweet is going to be. So just be aware. So that anything could happen by next week that could provide some more uncertainty, because number one, we had the jobs numbers, which were absolutely lousy, making Jerome Powell look absolutely ridiculous, if I'm going to be honest with that. But at the same time, you have Trump firing the commissioner of the BLS, the Bureau of Labor Statistics, because of the numbers were bad, maybe because the fact that the numbers were actually fake, right? Or because if you have too much of revisions on only one side and not to the other, it doesn't really sound as a statistical error. So I'll let you be the judge of that. But that creates a whole side drama that provides some short-term turbulence. I would see those turbulences as just opportunities. That's our base case for right now. But it's we don't know exactly how long it's going to last. It also can add the TJ refill can add fuel to the fire, maybe not too much. So I would be glad to see further corrections, because not only they are welcome, and a market can never go on a straight line for sure, but the fundamentals actually rule what happens next. So we have fiscal coming from the United States, pretty hot, and it's going to continue to do so, especially after the TGA is properly refilled. And also China has generated a lot of liquidity on their end as well, and they can affect positively, even if the United States is temporarily negatively affecting liquidity. So it's all about a pool. Try to see that as a liquid that just flows around, and sometimes you're going to have a counter current. Sometimes the tide is going to be down, and sometimes the tide is going to be higher than usual. But the idea of more and more liquidity over time is still in place, so that does not change. But of course, this week is going to be fundamental for us to see what happens and what comes to mood, right? So to the mood, I'm going to release this video on Monday morning. Maybe the market has already forgotten about that, and everything that I said is just going further away. But still, I would still expect some turbulence to happen on those side dramas. TJ refill, maybe smoothing out, maybe not too much. But again, fundamentals really rule here. So I hope this helps. So let's see what happens to this week, and see you on the next video.